Good evening. This is Tom Alexander. It is Monday, April 21st. This is a special update that I'm doing today in light of the big decline in the stock market, as well as I want to do an update on gold. Now, I typically don't cover gold in this video. I do cover it in the weekend report, in the written report that you can access on the website, and I'll show you guys that in just a minute. Uh, but I want to show you, let's start with the indices here. We had an interesting down day across the board. However, while everything declined today, we had the big gap down in the cash market. The indices are off the recent spike highs to varying degrees. And because of that, I think that, about a week ago, I started positing the idea in the reports that we might retrace, and then there were a couple of potential paths of development. One was that we trade straight to new lows and then maybe bounce from there, maybe form a larger degree balance area, or we would retrace something roughly half of the range, and we would develop a balance area in there. And so with today, there are reasons that is still in play. The idea that we're not going to trade straight to new lows or make lower lows immediately, and that maybe today marked a low, another short-term low, and possibly now we get another rally back towards the recent highs. Let me just show you what I'm talking about. Now, if you look on my screen, if you look at the top six panels, these are the various indices. The SPX, it's down almost 7% from its spike high. The NDX is down about 8.5% from its spike high. The Russell is down about 5.6%. The Dow is down the second most behind the NDX. It's down 7.33%. And then you have the New York Composite, which is down a little over 4%, and then you have the equal weight S&P. This is the equal weight. It's an ETF. It's equal weight SPX, down 4.67%. So once again, the things that are getting hit the hardest are the technology stocks. Everything is not in sync. If we were having some major crash because of some sort of systemic problem, you would see all the indices pretty much down the same percentage. We're not seeing that. So let me just go through one by one. Now, also, again, if you want to see these charts, I have posted these charts. If you go to alexandertrading.com, click on weekly update. This is free. You don't have to pay for it. Click on weekly update and then click on special stock and gold market update. You can also, if you choose, you can go back and click on weekend reports going back at least a couple of years. But if you click on this, you can see the charts that I have here. As a matter of fact, I will put but I'm not going to do that. I'm not going to put a PDF in. You guys can just look at this. If you want to copy the charts, you can figure out how to do that, I'm sure. But this is where you can see the charts that I'm going to show you now. Okay, so here's the SPX. We're down about 7% off this spike high. I thought we might balance a little bit, have an extreme a little bit higher, but this late rally sort of supports the case that maybe this low is it, and now we're going to balance in here. Now, if that's the case, if I'm right about that, you're not going to see much price action below today's low. If we have another day like today, then it tilts the odds dramatically towards seeing one or more of the indices take out this low eventually, sooner rather than later, before you get some sort of ripping rally. So that's the SPX. And then, of course, the NDX is down 8.5%. Then it's followed by the Dow, down 7.33%. And then we have the Russell, very broad index, is down 5.6%, showing some relative strength. New York Composite very broad index, all stocks listed on the New York Stock Exchange, down 4.1%. And the equal weight S&P is down about 4.67% or so, not quite 5%. There we go. So for those reasons, that's one of the reasons. Now let me show you something else. This is a 30-minute SPX chart that we show. We use this very heavily in the live room every day. And today we got down, we spent a considerable portion of the day below negative 2,000. Now we had this ripping rally at the end of the day, the last hour of the day. And that levitation also expanded breadth from this negative 2,000 level from where it spent most of the day. It also expanded, and we closed right at negative 1866. That's pretty extreme. Okay. Now, I'm sort of inferring from this that we could have another down day. I mean, we had 2 or 3 down days similar to, in this waterfall decline over here. So could it happen again? Yeah, it could. But we're still, as of the close tonight, we're still considerably above the lows. We're 6.28%. Now, could we do that in the next couple of days? Very easily. I mean, this was a pretty big decline over here in 3 days. So could it happen again? It could happen again. But we're holding above, well above the low right now. And we generated some extreme readings over here by this measure. And then also the internals here. This is NYSE data. This is a 10-day moving average of NYSE advancing issues. It's red. The green is 5-day NYSE advancing issues. And of course, then we have breadth down here. And you can see breadth is about as negative as it has been in this decline. And we're holding well above this low. The 10-day moving average of advancing issues is actually increasing on this decline, which is rather interesting. And again, as I put in the report, I'm not sure what to make of that. However, the point of this is it's a real possibility that we're not going to go directly to new lows and that we attempt to rally back towards this spike high. Just factor that into your strategy and tactics. Okay, let's take a look at another market. We're going to take a look at gold. Now, gold has been the best performing asset, I think. I'm pretty sure I'm right about that. Best performing asset class this year. This is a 60-minute chart of gold. And you can see the 60-minute chart it's almost vertical. Higher highs and higher lows. Now let's go up in time frame. Let's go to a daily. Same thing. It's vertical. Now let's go to weekly. And it's vertical. Now, this is sort of interesting. I went back and looked at similar quote unquote blow off types of moves. And I just sort of arbitrarily picked the beginning and the end. So, just in the interest of full disclosure. So, if we pick this level here, you can see we're sort of in the neighborhood of well, I say recent. This goes back all the way back to 2011, but similar blow off types of tops in this time frame. This is weekly, by the way. I'm going to take this off. Now let's take a look at monthly. And it's the same view. We have quite it looks like a blow off. Now, I am not suggesting that you sell gold. There are a million reasons to hold gold long term. If you are an investor, I certainly wouldn't necessarily sell my gold. That's a personal decision. What I am suggesting is that what I'm seeing now is that it is unlikely that gold is going to continue at this rate of change. And it is increasingly likely that gold is going to do what we refer to in auction market terms, balance. Let me show this. This is a profile view of gold. Now, each of these profile units is 1 month of trade. If I split this out, each letter, basically, this would be a bar chart. So each letter would be a bar. But if I remove the splits, this is what you get. Now it's, all markets that we trade are auction markets. All auction markets follow the auction market process of development. And they're basically two phases of development. There's vertical and there's horizontal. And you're in a constant transition in time frames at all times from one to another. Well, this is too vertical. You're going to see some balance. You can see these are quote unquote single prints here. You're going to begin to get some overlap. You can see how extremely vertical April has been. I'm going to add splits. So we're increasingly due for some sort of balance. Now I'm going to go up in time frame. Let's go to a weekly profile. Now, each profile unit you see here is 1/4 of trade. So each letter is a week. But you can see how vertical this is. This quarter has begun. And you can go back and you can look and you can see, if I didn't tell you this was gold, I could tell you this was the S&P. I could tell you this is rough rice, et cetera. That's the beauty of understanding price action through the lens of the auction market process. We're seeing it in real time right now. This rate of change is not going to continue. Okay, this is weekly. Let's go to monthly. Here's monthly. Same thing. So each letter is 1 month of trade, each profile unit. And you can see how vertical this year has been so far. Okay. Now, again, I'm not I'm not one of these people that uses magic to predict a certain number that gets hit that's going to cause it to stop. I'm using I'm looking at price action through the lens of auction market development. And I'm just suggesting that this market, gold, is increasingly likely to balance. Now, how much retracement that includes remains to be seen, but it will include some retracement. So I'm just throwing this out there because there is a lot of interest in gold at the moment. And if you're not in gold and you want to buy it, there might possibly be a better time to buy it than right now. If you want to add to your position, there might possibly be a better time to add to your position. That's all I'm saying. You guys have a great evening, and I'll speak with you again soon.